Global oil prices have spiked to the highest level in about a year, inching closer to the $100 mark. The international benchmark Brent crude hit as high as $97.8 per barrel earlier in the session before slipping slightly. The boost in price comes after United States crude stockpiles saw a sharp drop amid growing worries over already tight global supplies. Well, higher oil prices are prompting inflationary concerns just as governments start to see price rises ease. In Germany, the inflation rate fell sharply to 4.5% in September, the lowest reading since February 2022, and that came in below market forecasts and compares with a 6.1% rate in August. At the same time, Spain saw its inflation rate jump to a 5-month high due to increases in electricity and fuel prices. The flash figures show the CPI there rose 3.5% in September, continuing the upward trend since July. The latest data from Germany and Spain underscores this ongoing economic divergence in the European Union. Eurozone interest rates are now standing at an all-time high of 4% in the wake of the 10th increase 2 weeks ago. And the European Central Bank hinted that this round of monetary tightening is over, at least for now. Well, let's talk to Daniel Gros, the German economist, board member and distinguished fellow at the Centre for European Policy Studies. Daniel, good to see you. Welcome to the programme. Help us out here. What's slightly confusing for people, particularly outside Europe, is this inflation figure jumping in Spain, falling in Germany. I mean, why are we seeing such different pictures in these two countries within the same Eurozone?
Because these countries had different policies. Spain used to subsidize electricity by giving the electricity producers lower prices for natural gas. And that's why for a while it had artificially low inflation. Now it's coming back to a more normal level. I think the German numbers are more indicative of the trend throughout the euro area.
Will these inflation numbers be seen to vindicate the ECB's decision to raise interest rates?
Certainly, it will be very happy to see that inflation is coming down. And the important part is that inflation is coming down not just because energy prices are now stabilizing, but also because all other goods and services have now moderated in price increases. And that's exactly what the ECB wanted to achieve.
The ECB hinted, didn't it, that it would not raise interest rates again, but with rising energy costs piling more pressure on prices. Is this realistic? Do you think this position could change?
It could certainly be change, but the key point is not so much how high rates go, but how long they stay high. Because that's what's preoccupying market at the present, and that's why long-term rates are going up, especially for Germany, but also for Italy. And therefore, if the ECB doesn't increase rates now, it might have to keep it high for longer. So that's where really I would be looking forward to.
We've been talking and showing the historic picture, past figures. Look into the future, if you would. Let's look over the next 6 months, 12 months. I mean, what's your expectation of where we're heading as far as Europe goes?
It's very likely that inflation will moderate further because inflation is sticky. Once it goes up for a long time. It comes down, goes down for a long time. More worrying is the fact that the European economy is really not gathering pace. And one reason for that might be that Europe depends so much on exports, and exports are slowing down in many parts of the world, but especially in China. Exports to China are not really getting ahead, and I think that's a big worry for you.
Daniel, good to see you. Thanks very much for your time. Daniel Gros from the Centre for European Policy Studies.